Hey investors, this is the Boom Bust Invest February 2023 market update, just looking at some of the major market drivers. The whole point of these videos is this is kind of research I do myself for my own funds. If you have pensions, you will have them invested in globally diversified funds and globally diversified bond funds. So all I'm doing is sort of sharing out this research that I do each month because I personally allocate based on where I think markets are heading. So I thought I'd just share this out on YouTube. It might help some people out as well. So the big US government yields, 10-year and 2-year. Let's just have a look. Currently, then, so this is the 2-year. So this is the Federal Reserve website. 2-year yield, Treasuries is currently heading in the wrong direction. Actually, it's approaching the previous highs. On the 10-year, similar story. Currently heading in the wrong direction. Not quite approaching the previous highs. So we're still on a sort of longer-term downtrend. We kind of need to see that come back down in order to support equities and bonds. So we'll see over the next few weeks, and on the two, so that's a 10-year and a 2-year. Once again, we kind of need to see this coming back down in order to. So I'm looking for that to come back down in order to allocate more to the globally diversified funds. Equities need to see these yields lower in order to resume their upward trajectory that they've been on in 2023. So just wait and see for that one, I think. So the US dollar. So again, this is boombustinvest.com/crash, and all of these charts are just live, and the links are all there, so you can sort of come and check these out if you want. So again, US dollar, I think we're seeing like maybe a flight to safety here. US dollar going back up again. We need to see that coming down over the next few weeks and months in order to support globally diversified fund valuations. Trajectory down, the trend is down from the peaks, obviously, but in February we're heading back in the wrong direction. So as long as we see the that this a lower high here compared to previous and come back down, then I'll be more confident to add allocation back into my globally diversified fund. However, currently not heading in the right direction, so wait and see on that one as well. Same picture being sort of across all of these videos, really. We'll know more in the next month about where we're heading. Currently, it's, as I say, it's not in the right direction. Inflation, however, is heading in direction. So we've got UK and US inflation here. So this is sort of the latest figures from Trading Economics. So the US is about 6 months, or the UK is about 6 months behind the US. Still stubbornly high, but at least heading in the right direction. The US is a lot lower, and I mean we could be sort of heading into deflation in the US. There's potential for a deflationary shock. I mean, if we overshoot. So we'll see, but at least that is supportive for equities and bonds, as these should be driving yields down. Obviously, the Federal Reserve has to cut, so they're sort of making sure that they kill off inflation. But anyway, the inflation is heading in the correct direction there for both equities and bonds. The core PCE, which I should have here. No, let's take a look at this then. Core PCE, so this is stripping out food and energy, sort of maybe a more accurate reflection of real inflation. So that is also heading down, which is a good sign. So carrying on, the inflation expectations then, the most widely viewed measures of these inflation expectation measures. So the University of Michigan, again, expectation that January 2023 heading down, the expectations are heading down quite nicely there, so that's a good sign. The ProShares Inflation Expectations ETF, that has again been heading in the wrong direction in February, so it's the same story. This needs to be, I would like to see this sort of coming down again, expectations coming down, in order to sort of confirm reallocation of equities. Same goes for the 5-year break-even zone. It's like a longer term measure that's widely viewed for inflation. Again, same story, heading in the wrong direction currently. Should be hitting long-term resistance here. This is going back to sort of like 2021, so we'd want to see that. It's just ticking down again, so again, we would need to see that hopefully coming down to confirm any sort of further allocations, or for me to confirm further allocations into equities. You see on the longer term chart here, going back to 2008, great financial crisis, and before, you know, we've been at levels. This is slightly old, so we've come back down to about here. So we're below that huge 3% marker on this chart here, longer term chart, which was higher than just before the great financial crisis. So we've been at levels higher than, you know, when we sort of going back to 2005 here, but we're back in the right territory. Producer price index also heading in the right direction. So this is kind of quite a long term. It's going back to 1985. See the recessions in grey here. So you can see how far producer prices have been bid up here after pandemic, coming back down again. This is a good sign, so long may that continue. If we see producer prices go back up, then you know, again, it's not conducive to further allocation to equities. So but currently it's okay, heading in the right direction. And then oil, the oil chart, again, that's come down quite a long way, which is good. Reason why inflation's come down, largely related to oil as well. So the cost of doing business, cost of energy. So yeah, I mean that's looking fairly healthy. Just a warning sign here that, you know, the spike that we've seen, you know, this is in 2008. When that spiked, it's when that prices start coming down. That's when we saw the big drops in the equity markets in S&P 500. So it's something we need to watch out for. If history is repeating itself, if we get a recession, you know, these spikes in oil are kind of harbingers of doom almost. So we just need to ensure that, you know, we kind of don't see this slide here. So, you know, this is 2008. We're kind of here almost. So we've come back up in 2023 after the initial leg down. The risk is, you know, we see history repeating itself. So this is what we're watching out for. You know, I mean, if you are dollar cost averaging, then, you know, the whole point of the video is not to sort of, not necessarily to time the markets. If you're dollar cost averaging here, then you know, and here and here, buying sort of consistently, then you're buying at lower prices. So that's still a good way to think of it. And I do that as well, but, you know, I sort of might delay some of my contributions based on if I think markets are going to come down further, I'll delay some of my contributions, so I'm investing here and here and not like here, you know. So yeah, we do need to keep an eye out for oil if it continues going down, and then how that relates to the equity markets. So, but at the moment it's good because it's supporting low oil prices, are supporting equities at the valuations that they're currently at. So that's fine. Just looking at some of the fund flows here, I don't profess to be a complete expert in any of this sort of fund flows. If anyone has any comments of better measures here, so I'm looking at the ICI Isabel Net, some of the graphs here. So with the ICI, so the Investment Company Institute, ICI Global. So the interesting thing here is what we're seeing here. So that there were the net 3.26 billion inflows, right? But that's actually made up of mainly of bond inflows and outflows from equities. So I mean, this is over, sort of weekly on 2023, going up to the 8th, so quite recent. So we're seeing outflows of equities. This is a big mutual fund in the US, and we're seeing inflows into bonds. So that's the interesting things here. Looks like we're sort of seeing a rotation. Although these are billions, they're not. It represents less than 0.1% of the long-term mutual fund assets, but still the trading direction, as it were, is out of equities and into bonds by these big players. So looks like a bit of a rotation going into bonds here. It's flight to safety. So we'll see if that continues, but that would kind of support allocation maybe to bonds as opposed to equities if you're going to use that as a factor in your decision making. Certainly bonds, the outlook has improved. They've come down a long way, and that's probably why we're seeing this sort of rotation into bonds here. So we'll see if that continues. And then, yeah, just a few more from Isabel Net here. So these are recent ones. So equity, so this is from the 6th of February. As we've seen, I think this has come down a bit over the past couple of weeks, but so this is the zero line. This is sort of equity flows in the billions, kind of cancelling each other out. I mean, the overall trend is like down since 2022. So we need to see sort of being maintained above the zero line really to support global equity funds. But yeah, currently I think it's come back down, so we'll see what that chart is showing. But obviously, if funds are flowing out of big equity funds, then the valuations of them or the price action of them will also be down. So we'll keep an eye on that. This is the Fund Managers Survey, Bank of America Global Fund Managers Survey. So obviously there's been a big exodus from equities according to this. So this is like whether it's overweight equities to bonds. So again, this is where we're seeing the sort of rotation into bonds here. That's quite low, for equities. So I mean, this is a great financial crisis. We're not far away. Currently upticking actually back into equities according to this, but it's very early days. Let's see where that heads. But we see the exodus from equities here over 2022. And so we'll see if this ticks up again. Then we could yet see 2023 as a sort of an uptick, an upturn, or the trend back into equities before 2024, which is possibly then when we might see some kind of recessionary influences coming in. This is supporting that thesis that the insider transaction, so directors or owners with 10% or more of a class of a company's securities, they're buying. So this might support this idea that we will see sort of rises in 2023, but again, we'll see if that continues. And then finally, the long-term market breadth, so the percentage of stocks above their 50 and 200-day moving average, which is a good kind of indicator of market bottoms when it reaches really low levels. Sorry, this one's a little bit hard to see this image, but great financial crisis, it gets down to like below 10%. So yeah, I mean, here we see 2023 where we are. We've come down to those levels that you see on the longer term chart here. We're back down here, and we've come back up. So I mean, these levels have actually marked the bottoms of the stock market, or significant bottoms, when there's been then a subsequent bull run. So that's 2020 COVID crash, great financial crisis 2008, that's there below 10, and then great dot-com bust 2002, reached a low here, and then went on a big bull run. So historically, yes, they have marked the bottoms. However, in this case, I mean, we've come off basically what was a massive policy response by all the central banks and governments around the world, which is what's distorted the market here. And so I'm not so sure that coming back down to those low breadth levels here really signifies that we're now going to go on a massive bull run. This can be completely artificially created. So yeah, I personally don't think that we can say that that's now a sort of confirmation of a market bottom. So again, we just have to wait and see on that one. So yeah, as ever, if you like the video, please like and subscribe to the channel. Let me know I'm not just wasting my time, and I can continue making some videos to help everyone out. And I'll see you on the next video.